Hi, and welcome to the Introduction to Israeli Taxation for Limbs, Part 5, and this is the last part, probably the most interesting part. And here I will tell you the things that only good tax consultants will tell you and probably will pay a lot of money for, so listen carefully. Okay, let's start with a bit of tax concepts. The Israeli tax system is called Mixed Territorial Personal Tax System. What does it mean? Israel wants to tax Israeli tax resident on every type of income, every income it has worldwide. So Israeli tax resident is taxed on personal basis, which means he or she is taxed based on all worldwide income he or she receives. Non-Israeli tax resident is liable to tax in Israel only for the income earned in Israel, which makes sense. A country can't tax, US tax resident for the gains in US. This will be totally illogical, impossible to collect, etc. This is called territorial system. So this is mixed territorial personal tax system. There is an exception, as we learned in session 2. Ole Hadash is exempt from tax on non-Israeli sourced income, passive income, and business and salary income earned abroad for the first 10 years. But now, let's ask ourselves a question: who is an Israeli tax resident? And this is not an Israeli citizen. And in contrast to many countries, the residency is not defined only by the number of days spent in Israel per year. For example, in my native country in Russia, if you spent 183 days in Russia in any particular year, you are a resident of Russia and tax resident of Russia for this year. And if you didn't, you are not the resident. That's not how it works in Israel. Israel has more complicated rules to define residency, and there is a space for discussion here. So Israel applies the center of life criteria. It's a combination of qualitative tests, means some kind of factors like where do you have a permanent home, where do your family members live, means your spouse and your children below 18 years, where are you employed, where are you doing business, where are your economic interests, investments, where do you participate in organizations, associations, non-governmental funds, etc. And there are also quantitative, like more classic criteria, like spending 183 days per calendar year in Israel. A second criteria is a cumulative one. If you spend 30 days in Israel in this year, but you have spent 425 days in Israel in total for the last 3 years, including the last. So you're also like trending to be a resident. None of this criteria is decisive. They are looked at together, at a combination. There may be situations when you spend 183 days per calendar year in Israel, you're still not a resident. The most popular example is an expat worker coming to Israel for like 2-3 year project, but his family is abroad, his home is abroad, his employer is abroad, but he sent him to Israel, and he intends to go away in 2 years, and despite he spends many days in Israel, full year in Israel, he's still not a resident. On the other hand, you may not meet the days criteria, but on the other parameters, you are Israeli, you rent a home, you own a home, your family is here, your kids are going to school in Israel, your employees here. So it's a hard concept to comprehend, and I'll add to it, the tax officer has a lot of freedom and flexibility to decide. On the other hand, you can argue with the tax office on this. Are you with me? You can argue with the tax officer, and you can bargain with the tax officer, and it's a very official process. It's written in the tax code that these are the criteria unless you persuade the tax officer otherwise, or unless the tax officer states otherwise. I call it bazaar approach to tax, but this is the Israeli reality. Maybe you will need it. It depends. If you are just planning a plain Aliá, means you're coming here, you are settling here, you're renting a home, you're buying an apartment, you are sending your kids to school, your spouse is coming with you, you search for a job, you will live in Israel, you maybe go abroad for family visits or vacations. That's quite a plain situation. But in the modern life, people make Aliyah and then they spend another 2 or 3 years still outside Israel, finishing their businesses and wrapping up their investments abroad, or they move, but their kids don't move, their spouses live in different countries. So the modern world is very complicated in this respect, in respect of global mobility. So there may be black and white situations, but there will be a number of situations, a range of situations in which your tax residency is not sure, is not certain. And if it's important for you, and we'll come to it, why it may be important for you, you may need to go to the tax officer, present him or her with all the facts and data and dates and your addresses and your family member information, and you will decide together. You will discuss and decide together. Definitely, I advise to take a CPA with you for this discussion, not to go alone, especially if your Hebrew is not that good. Okay, some situations. By default, you may remember I told you the tax code, the Pkudat Mas Haknasa, says your 10 years of exemption for Alim benefits start at the date when you first became an Israeli tax resident. And this is not Aliyah date, not necessarily. But by default, the tax authorities will have your Aliyah date in the papers because they have a database linked with Ministry of Internal Affairs. You also have your Aliyah date in your Teudat Zeut and your ID, like internal Israeli ID. So by default, if you don't come to tax authorities ever, your 10 years will start ticking from your Aliyah date. But let's see what happens if your situation is a bit more complicated. I made Aliyah, but I didn't actually live in Israel. Now, several years later, I came to settle. So I want my 10 years of exemption to start from now because I never lived in Israel. My permanent home was never in Israel. I made Aliyah, but my family didn't move there. I didn't have a business there. So why have I became a tax resident from the date of Aliyah? This is possible. This is possible to argue. It's not automatically granted. You will need to request a private letter ruling to describe everything to the tax authorities, to negotiate with them, to prove, to answer the questions. And possibly they will give you the 10 years, which are starting later. They will define your date of beginning of tax residency later than the date of your Aliyah. There is such thing as a green route for confirmation of the date of residency, but based on the green route, they will automatically issue you the certificate that your date of residency is the earliest of the date of your Aliyah or date of acquiring a house in Israel, which doesn't help in this particular situation. Okay, so 10 years seem a lot of time, but at the end of the day, they will end. So what happens next? Imagine after 10 years, you sell shares in an apartment or an apartment abroad. Your 10 years benefit will not disappear. You will still not be taxed in Israel on proportion of this capital gain, which relates to this 10 years. What do I mean? If you bought an apartment, I don't know, in the US, immediately before you came, and you sell this apartment in 12 years, so only 1/6, like 2 years from 12 of the gain will be taxed in Israel. And definitely you can get a credit in Israel for the tax paid abroad in the US in this particular situation. So your 10 years are always exempt. So technically there is no rush to sell everything in like before 10 years pass. What happens if you need a certificate of your Israeli tax residency? This is an interesting moment because at this moment, suddenly, Israeli tax authorities don't want you to be a resident because you're trying to get some benefit. Why may you need a certificate of Israeli tax residency? For example, you are getting payments, dividends, interest, royalties from some countries who have double tax treaty with Israel. It means the agreement on the avoidance of double taxation. We will talk about it later. For example, the domestic rate on dividends is 25%, but under the treaty with Israel, it's 10%. And they are trying to get a better rate in foreign country. And you come to Israeli tax authorities and say, can I have a certificate that I'm an Israeli tax resident? And they say, no. You will first need to prove us that you're an Israeli tax resident. We will not calculate it automatically from Aliá. Maybe you haven't lived here. Maybe your center of life is not here. Prove it to us. And normally you will have to file the tax return for this, even if you don't have to, under other criteria that we discussed in session 3. And in practice, this is nowhere written. This is just the experience of my colleagues who are dealing with the tax authorities daily. You can get a certificate only after spending at least 2 years in Israel, more or less full time. That's realistic. Okay, let's move forward. Managing double taxation. A lot of you have heard about the existence of the treaties, tax treaties, or agreements on avoidance of double taxation. What is a tax treaty? The tax treaties have evolved in the mid-20th century as a reply to the growing globalization of the business. So a lot of businesses and a lot of individuals residing in one state started receiving income from another state, a foreign state. So they fell into a situation when both states, the states of the source of income, like a source country, and the state where they are residents, want them to pay tax on this particular revenue. So it means that revenue starts to be taxed twice, which is not fair, which is kind of very demotivating for the business. So the countries came together and agreed we will put together like bilateral agreements. They are made more or less based on the same models. It's like 3 models worldwide, so they're all more or less the same to avoid the situation. So what the treaty may say for any particular type of income, it may say only the source country has the right to tax it, only the resident country has the right to tax it, or the source country may tax up to certain amount, and the resident country can tax the rest if its tax is higher. So it's basically a split of tax between countries. But when does it help? It helps you when you have either a source in one country and a resident of another country, and you can get a decreased rate of dividends or interest or royalties. Or tax treaties also work on the situations when you are a resident in 2 countries simultaneously. We talked about this, that the criteria of residency are different in different countries. For example, US is the extreme example. United States treat any US citizen as resident, as tax resident, full stop. If you have an American passport, you're an American tax resident. But at the same time, you may live in Israel, have everything in Israel, your center of life is in Israel, you're an Israeli tax resident. Israel also wants you as a resident. So the treaties are resolving the situation, and they put a kind of set of criteria, and this criteria apply one by one. Not like in Israel altogether, and you discuss, they strictly apply one by one. For example, the first criteria may be the permanent home. If both countries treat you as resident, the country in which you have the permanent home will be your residency country. If you have home in both countries or do not have any, you go to the second criteria, to the third criteria, to the fourth criteria. How can treaty help you? First, the treaties are good. The treaties are never bad, because the treaty cannot make your tax situation worse. The treaty cannot make you pay more tax than you pay on 2 domestic legislations. It may only make your tax situation better. In some cases, the treaties with Israel may be extremely beneficial. Because, for example, if the treaty says only the residency country can tax the capital gains from sale of shares, and you are an Israeli resident, or Lechadash, who sells the shares of country X, I will not tell any specific country because the rules may differ, and these countries have a treaty, and the treaty says only the residency country can tax this capital gain. So what happens? Treaty says that source country can't tax it, so country X can't tax it, and Israel gives you a domestic exemption, so you are not taxed anywhere. This may be nice situations because Israel is really, really generous with granting tax benefits to Olim. On the other hand, with real estate, the treaties almost never help you because all the countries treat real estate as an asset very much connected to this country, so it wants to tax it anyway. So if you sell an apartment or some other real estate in your home country, in another country, usually it will be taxed in this other country anyway. Coming back to what we discussed in the second session about the employment, and I told you that tax treaty will not help you in this particular situation. If you are sitting in Israel and working for a foreign employer, why the treaty will not help you in this situation? Because from Israeli tax perspective, you, Israeli tax resident, is receiving Israeli sourced income because you're sitting in Israel and doing work in Israel. So there is no residency source conflicts. There is no dual residency conflicts. From Israeli perspective, it's Israeli resident, Israeli income, very simple. You should pay tax. You definitely may take a credit for tax paid abroad. Nobody will take tax twice. But if Israeli tax is like, I don't know, 30% bracket, 31% bracket, and your foreign tax was 20, you will pay the difference in Israel, like another 11. You will complete another 11% in Israel. If the tax abroad is higher than tax in Israel, you will not pay anything. But you need to report. Okay, for applying double taxation, double treaty benefits, you will need a certificate of residency that we discussed last time. Usually in Israel, it's quite tricky to get them immediately. You will need to spend a couple of years here to even go to the tax authorities and let them listen to you. Okay, home country planning. Most of you listening to this presentation have not made Aliá yet. So I really advise you to think about your taxes and about the combination of your home country taxes and Israeli taxes before you make Aliá. Sometimes it may even impact the months in which you want to make Aliá, because you may think, is it beneficial for me to spend 183 days in my own country the year I make Aliá and fly in September, October, end of the year? Or it's more beneficial for me to make Aliá in the first half of the year and be a resident in Israel already. For example, in Russia, this is crucial because Russia has different rates for any types of income for resident and non-resident. Like it's 13% versus 30%, 1-3 versus 3-0. I can't tell you the situation in your home country because you're all coming from various countries, but I'm just listing the topics which you should think of and which you should discuss with the tax advisor, and choose the tax advisor who is specialized in relocations, because a lot of tax advisors are working only in their own country and know only their kind of domestic legislation and never had experience with people changing countries and moving around. And this is very specific topics. Check if you need to file the tax return for your last year in your home country, or whether you have to continue filing the tax returns. For example, in the US, you will have to file tax return every year. You probably will not pay anything, any federal tax at least, and state tax, but you will have to file, you will have to continue filing. Do these countries have any exit taxation? Some countries are implementing this anti-planning measures because, for example, you lived in some country and you had investments and they grew up in value a lot, and you want to sell these investments, but this country has high taxes, so you move to some other country with the low taxes. You sell these investments, hooray, you don't pay tax. No, it doesn't work this way. In the clever countries, put some controls to it and some limits. So you basically will have to pay some tax when you exit the country, or you will have to come back to this country after you sell the asset and pay tax there. So this, especially like European countries like Netherlands, like I think Switzerland may have it. Like, so check it before you go. Check Social Security, check your pension if you have sizable pension contributions in your home country and you want to continue managing them or receiving them, check it. Estate planning, nobody likes to think about the death, but you need to understand what happens with your home country property if you die, and what will happen if you move the country. Like, you may consider disposing of some assets before or after Aliá. Again, what we discussed previously, there may be benefit to hold it and to dispose it 2-3 years after Aliá to get the treaty benefit. And last but not least, transferring money abroad is not easy these days. Banks are really, really afraid of money laundering, and they are imposing controls on any money coming to the country. And banks are like, to the level that banks are not happy to take your money. They will rather not take your money than risk any like money laundering lawsuit. So check the currency control in your home country and in Israel as well. Check anti-money laundering. Check which documents will you have to bring to the Israeli banks to bring the money. It's not exactly tax related, but why I'm speaking here about this, because one of the things the banks check is that the money you're transferring was properly taxed in your home country. So the best thing you can bring them is some kind of tax return from your home country, showing that this money was earned, reported, and the tax was paid. Also, the exchange of bank information is a new, relatively new regulations. You may have heard of FATCA and of CRS. FATCA is exchange of information with US, and CRS is international, like other countries' exchange of information. The banks are obliged, or will be very soon obliged, to report the information foreign tax residents to their residency country. So the banks here in Israel will also ask you about your second residency, about your second citizenship, and you will have to disclose it, and potentially they will disclose this information to your home country tax authorities. Okay, that wraps up our 5 webinars on the Israeli taxation for Alim who work as employees. I hope it was useful for you. I hope you now have much clearer picture of which taxes would you need to pay in Israel and how the Israeli system works overall. Feel free to contact me on the email. I will be glad to speak to you and to help you with the situations. Bye.